in finance. I think the world wants, in the poor and middle class, they want money to be automatic and simple. They want to hand it over with no responsibility and have someone give it back to them. And this is why there's absolutely no hope for them in that situation. There isn't. Like, I don't mean to, rain on anyone's parade here, but 95% of people at age 65 are not economically independent, according to the US Department of Labor. 95% of Americans, they get there, if they stop working, they're going to lower their income and not be able to make ends meet. Is that because of a lack of effort? Well, it isn't a lack of saving money. It's a lack of knowing how money works. So in the framework and context of today, there's really 4 main segments that I want to uncover, unveil, and then we can definitely have discussion around. The first one is going to be around mindset. And in mindset, there's going to be a couple different sides to the coin to give more insight into this world of scarcity. Because scarcity is this silent killer of wealth. It's kind of this mindset that people have where they believe it's a reality and therefore they act within that perspective. And that first part of that mindset is really this playing not to lose. And I don't think there's a lot of people in this room that are stuck in playing not to lose, even though most of society is stuck in playing not to lose. It's the thought that you could save yourself rich, right? You're gonna pinch pennies until you get blisters on your fingers, but hopefully one day, someday, you'll end up with a lot of money, and that's the millionaire next door mindset, where you have plenty of cash, but you're broke. Where you've got a lot of money, but you don't enjoy it, right? And that kind of mindset where people, I went to an event recently where this guy, he had 1.8 million subscribers on YouTube, so I wanted to learn from him, and everyone in the crowd asked the same question. I've been thinking about doing this for 7 years, for 15 years, and it was so rudimentary on the questions, and he's just spending all the time getting them to take action. In playing not to lose, people don't take action because they fear what might happen when they take that action. What does that mean if they're not successful right out the gate? And here's the reality, is we're not gonna be successful every single step of the way. It's not gonna go completely smooth. We're gonna make certain mistakes, but we're gonna learn from those mistakes. Just like when we were kids. When you're a kid and you walk for the first time, your parents actually celebrate the first step, not get upset that you fell on the second step. And they don't think because you fell that you're never gonna get up and learn to walk. We just assume that part of the mistakes are the process of getting where we want to go, but in playing not to lose, there's no room for mistake because all of a sudden it means that we're not good enough or that we're not worthy or what will people think? And we spend so much time consumed in that type of thinking. And like I said, that's not where the majority of the room is, but there's a different form of scarcity, more subtle yet even more destructive. And that other form of scarcity is playing to win. Playing to win is what you'll read about in magazines. It's what you'll see on the cover of magazines. It's where you're going to hear about the people that we hold up as icons and heroes. And we say, these are the people that we want to be like. But as soon as we unveil a little bit about their life, we find out that maybe they're successful in one area based upon what society deems success to be. And I think that's a major trap, societal success. Society doesn't celebrate family. Society doesn't celebrate experience. Society doesn't celebrate recreation and rejuvenation unless it's showing off because you're in a private plane, right? It's all about this monetary wealth. It's about awards. It's about accolades and recognition. And it became part of this American dream where it's like, did you have a big enough home? Did you have the right kind of car? And people checked the boxes, but they found out they weren't fulfilled because we live our life for someone else's definition, not our own. And so a lot of this win then play is about the journey, but it's about identifying what a win is for you. And when money is the only benchmark, it's never going to be a win. Here's why, because you'll meet someone with more money. You'll get to the point where you thought you had enough money, but then you realize that there's more to get. And all it is this never-ending horizon of more, and it's a complete disease that's demonstrative. Look, and I got it. I did that in my 20s. In my 20s, I just want to have more than anyone I knew, and then every time I met someone that had more, I was just pissed off at them and frustrated, couldn't celebrate that, and then I started to feel bad about myself. I could have a moment, I have a friend, his name's Jeff. He had a private plane, and when he landed in his private plane at the airport, he looked over and he says, whose plane's that? They said, oh, that's Huntsman's plane. And it was bigger than his, and it was nicer than his. And he went from feeling really rich and great to feeling like a complete failure in life because someone had a bigger plane. That's societal success. And look, our friends from Texas say it well, since we got, it's like, all hat, no cattle, right? Like that's kind of what happens in a lot of these situations. And so that playing not to lose, I want to leave you with a few questions to really, or playing to win, leave you with the questions to really ask if the win is right for you. So when you look at whatever you're doing in life, I want you to just ask, is the juice worth the squeeze? Is the juice worth the squeeze in what you're doing? There's plenty of ways to make money, but not every money-making way is the best way, right? It takes being more abundant to actually say no to certain things, to reserve and be abundant enough to know that the right opportunities will come along, and to focus rather than diversify because you're really dialed in with what you do. The next thing is play to win at what cost? At what cost? Like, okay, you're gonna get there, and even if you get there, what do you lose along the way? Because plenty of people lose relationships, they lose health, they lose a lot of things in the playing to win philosophy, and it doesn't take much research to figure this out. I mean, now we're seeing articles about Elon Musk being pretty miserable. He's sleeping at the office, he's not getting more than 2 hours sleep. You know, he's gone through a divorce, his wife now is writing articles about it. Like, a lot of that was because he had his eye on a pretty amazing, spectacular vision, but that vision didn't have room for him. So like, for me, it became, what if money was a cool benchmark, but I had a benchmark called quality of life that began. It was quality of life first, and then money was second. And it didn't mean an either or, it just meant that I can have consideration and I could start to say no to things because it didn't equate to quality of life. It wasn't like, hey, I can make money by doing this, so I'll just say yes, but at the same time, diminish my health, be away from my family, come back exhausted, you know, have less to give. I think that's the trap of play to win, is we don't actually have the best of who we are because instead of thinking about scale and leverage, we're just busy. We're just doing. So the first piece being mindset, we identify where play to win becomes very destructive. I just spoke at the MIT Endicott House, which for the alumni, and that was this thing called Gathering of the Titans. And they asked a few people during the event, like that were new to the event, what their last words would be on their deathbed. And this guy literally said, I'll just tell people to play to win. I'm like, oh my God, I'm gonna blow this dude's mind. I'm about to blow this dude's mind because play to win, I could just feel it. I could just see the tiredness in his face. And we had a good conversation after my talk. So the third mindset is gonna be this win, then play. W-I-N, win first, then play. And the ways that we're gonna do that is in three main segments which bring out the other pieces. So the second piece will be money. So in the win then play world, there's a few ways we look at money. One is through efficiency. How can we just keep a lot more of what we make without working harder? We'll focus on 4 I's and more. One of the 4 I's I'll dive in deep, the other 3 I'll skim, and then if there's questions we can cover it. The first one is the IRS. It used to be 93% of business owners were overpaying on tax. Now because of 199A, it looks like it's more like 97, 98% based upon our surveys that we've been doing. The second way to save a lot of money is interest, how you structure your loans, everything from restructure to renegotiation to even reallocation, which is where you get your funding, and maybe even if you fund things yourself. And then the third I is investments. There's a lot of hidden fees, there's a lot of commissions, there's a lot of non-performing fees, and more importantly, there's a lot of downside risk people are willing to take because they think it is what's required for return. But if I can teach you how to mitigate and manage risk better, you'll just have more money in the future. So that's the third I. And then the fourth I to efficiency is insurance. Whether it's you set up your own insurance company and you eliminate a lot of insurance costs, or whether it is you don't insure inconsequential things and you only insure catastrophic things, and it ends up being that you transfer more risk with the same dollar, or you put more money in your pocket, or we just find duplicate coverages or costs. Like, these are big momentum things in money. We're not talking about, hey, clipping coupons or not eating out. Like, that kind of stuff might make a little difference. We're talking about the major difference that doesn't infringe upon your life. That's one way to win then play, is to find that. Another way to win then play is economic independence. Economic independence is when your assets create enough cash flow to cover your expenses. We're just talking about basic life expenses. We're not talking about being in this lodge every day necessarily, but we're talking about just the basics of life. When that's covered by your assets because you think as a cash flow investor rather than an accumulator, and when those assets are doing that work for you, then what you can do is you can swing for the fences in everything you do because you've already won the game. You can think more about vision, impact, quality of life, whatever it is that matters most, so that you're making a choice with your daily actions, not doing it simply because you have to pay a bill that day. That's a game changer. That's economic independence. That's a win-then-play methodology. And I'll give you what that framework is. And then another win-then-play is how can you make money on the buy? How can you make money on the buy? Like, I think that the world has been erroneously taught that net worth is the god of finance, that it's the ultimate measure. And the more net worth that we have, the more wealthy we are, but the reality is net worth, it's a lot like muscle. It's great to have, but you know what? Cash flows like blood. I don't care how much muscle you have. If you don't have blood flow, that muscle isn't worth anything. So cash flow is absolutely king. We've heard that over and over again, but this is how I think you make money on the buy. Is if we look at people that are simply looking at a balance sheet as their main focus, right? They're just trying to boost more assets, minimize their liabilities, so they have more equity, they have more net worth. These are the people that become most susceptible to loss in recessions. We're in the second longest period in US history without a recession, right? So what's happening is all these people that are focused on net worth, when a recession occurs, they're not really good at managing the downside risk. When those assets start to decline, then we see a few things happen. Either one, they're in a cash crunch now, because before they can get a line of credit easily, or we saw that in 2008. Like, there was a lot of people that just went and got home equity lines of credit because they lived in Vegas or wherever, and the market went up. And you can get it if you could fog a mirror. They just started giving these things out, and so now they're buying things on that credit, which still has a payment attached to it. And then all of a sudden, when they can't access that, and maybe their income drops or their business changes, or they don't make these adjustments, now they have to start selling assets. And guess who makes money then? People that have cash. When you have cash, you can make money on the buy. That's a win-then-play. When you think about making money on the buy, two ways I think of making money on the buy. Number one, I'm buying it at a song, at a discount. I'm helping them get liquidity I'm paying way less than what it's actually worth because of their situation. And two, if I can create more cash flow than what the cost is associated with it, I've already won. I'm already generating more economic independence and cash flow. So the first thing is mindset. We're going to talk about a win-then-play mindset. The second is money. We're talking about the 4 I's to efficiency. We're talking about economic independence. And we're also discussing how to make money on the buy. The third piece, I was just on the phone with someone they now have a $10 million business without starting with a single dollar. Like, this is a really cool concept. This is called the cycle of creation. So we go money, mindset, then money. Now we're going to scale. Now we're going to business. And the cycle of creation is really 4 main phases. And it's not how business used to be done. Business used to be done on who did you know, how much money could you access, what money could you give to a government to support you. There was so much more complexity for someone that had big ideas. In today's world, there's the cycle of creation. This is a very win-then-play concept. So let's just say that you had an idea, right? Just any idea. Like, for me, it's the book Win Then Play as an idea. That's an idea. I've actually got the manuscript, and in August, we'll start selling the book before it's released. We're going to sell it to people before it's released because I'm going to do the audiobook before I release the physical hard copy, which isn't what normally happens. So people can immediately get a download and get the physical copy sometime in Q1. Plus, I've done 4 webinars, and I did the transcripts and rewrote them. And we're putting together a journal. So anyone that buys it ahead of time gets all these exclusive bonuses only for that time period, which means we could pre-sell books before we actually have them published. I did 22,000 copies of Killing Sacred Cows before I ever held it in my hand. I just pre-sold it. I said, hey, you want to have me speak? Buy 500 copies. Had a ton of financial advisors where I'd say, hey, if you buy 250 copies, I'll do it. Back in those days, it was a teleseminar series, specifically for your clients. So they use it to educate them. They interviewed me, and all of a sudden I would sell a large, bulk of books, and then I also gave bonuses. Back in then, it was DVDs and CDs and stuff like that if they bought up front. But so you can have an idea, and an idea is something that's just in your mind. It's kind of, you haven't shared it yet. But the next phase in an idea is where it can really become profitable, and that's a concept. When an idea moves to a concept, it's more materialized, it's crystallized, it's shared somewhere. And where you can see concepts all day long, Kickstarter, Indiegogo, GoFundMe, you just see concepts. I just talked to the people that did the Best Self Journal, right? The Best Self Journal, they raised, I think, $275,000 to produce this, which, by the way, this is what I love about it. They didn't go raise money from investors, because no investor really cares about 250 grand unless it's family and friends. It's no venture capitalist that's ever gonna fund that. You're not gonna find angel investors typically are gonna fund something that small. But the reality was they owed no money when the product came out because their end user was the funder. They actually built momentum. And this is what's great. Some people make the mistake of getting feedback from the wrong people. Like the way that we make mistake getting feedback from the wrong people is if I took and I had a concept of my book and I said, hey mom, what do you think? She's gonna tell me she likes it one way or the other. It's my mom. She's not writing me a check for it, right? Or ask family and friends. And they either are overly critical because they don't like me, or they're overly nice because they do. They have all these biases and all this information in their head that's clouding their judgment, and we're getting feedback from people who don't write checks, and that's not valid feedback. People that don't write checks many times are just not your customer, so who cares what their opinion is about your product? I like to go to a concept phase where now I can share this publicly. And so when we did our very first video series, it was called Fast Track on Demand. And we didn't have a finished second floor of our building at the time. And I want to put a TV studio in there with a control room and the quiet air conditioners and all that kind of stuff. But I didn't want to just go, cash out all my money for it or go borrow money. So what we did was we just sent a survey to anyone who had ever bought anything from us in the past. And we said, hey, we're thinking about doing a video series. What do you think? And then they told us what they would like. Anyone that responded to the survey, we had a salesperson call them and say, hey, you want to be part of the beta group? The beta group, it's $1,250 instead of the full $2,500. So we pre-sold it. And we said, here's what we're asking because we're charging you less. One, we need a load of patience. It might not be perfect the first time around. The technology glitches might exist. So we actually asked for that patience. The second thing is we said, we want your feedback so that we can actually deliver what you're looking for. What's going to get you to watch it? What is it you're looking for as far as information? We ended up building tests. I wasn't planning on building tests, but people wanted that. We ended up creating, workbooks. We ended up doing a few other things. And then when it was actually time to come out, well, we already made $150,000 up front, invested $100,000 in a TV studio, $10,000 in the video editor, and I walked away with 20 grand, and the other Garrett that filmed with me walked away with 20 grand because we did it up front. I just went to the Indy 500 this last weekend. Turns out one of our clients is the heir to the Indy 500, and didn't know this, but I went and spoke in Indianapolis. They hosted it in the Pagoda, and I was like, this is amazing. They're like, oh yeah, this is ours. I'm like, oh. Like, would you like to come and have a VIP experience at the Indy 500? I was like, I sure would. And I'm telling my wife, I'm like, let's go to the Indy 500. She's like, I'm not into that. She's like, it'll be hot. I'm like, we're not gonna be in the heat. She's like, I'm reading, you have to walk everywhere. I'm like, I'm pretty sure we're not, they gave me a personal cart with my name on it. It was a phenomenal experience, but what I was thinking about in a win then play way is they had already won before the race happened. They already pre-sold all the tickets. And these guys really figured out how to win then play. First off, they have all these young kids that go to something called the Snake Pit where they have DJs performing. And so people go and they don't even watch the race even though they bought tickets. They're just listening to DJs and they start at 7:30 a.m. 7:30 a.m. and then they just go all the way through the race. And then there's an entire golf course inside of the Indy 500. Just an entire golf course in there. Think about all the ways they figured out how to monetize this. And then they've pre-sold the tickets. And then I actually got a ride in a car. I thought I was going to get to go with Mario Andretti. I was a little nervous about that, by the way. He's 79 years old. And I didn't want him to be like, Mario Andretti crashed and died and some other Italian was in the car with him. Yeah, by the way, his car went 20 miles an hour faster than all the other cars. But I actually got to go ride in an Indy 500 car the day before the race on the track. So they just think of all of these experiences, right? So these are just win then play things. And at one time, they're just a concept. So they even in the Christmas time, you can drive on the track and look at Christmas lights that they set up. They're just thinking of all these additional ways to monetize because every time you go through the cycle of creation, you're looking at additional ways to add value, to get more money with the existing assets. And I feel like this is where a lot of wealth is lost, is we don't extract all the value from our existing assets. whether that's a business, whether that's creating cash flow, whether that's maximizing tax deductions. So since I know a lot of you do real estate, there's amazing benefits that way. So in cycle of creation, let me just give you kind of a little bit of a formula, because the reality here is it's a value creation formula. And really, if you've read books like The Lean Startup, this will follow some of those principles where you start with something that's minimally viable, that you're doing that beta version, you're pre-selling it. But the way that you move through the cycle is through the value equation, which is your mental capital. So what are your ideas, knowledge, wisdom, tools, systems? And you multiply that by your relationship capital. So your relationship capital are networks, organizations, individuals, masterminds, freedom founders. It's all these people that you could tap into, their knowledge and their networks. And every time you begin with an idea, then you're looking at what mental and relationship capital it's going to take to make that a concept. So it could be anything from what you already know to who you already know, or who even you don't know but your network knows that can move that along. I mean, Bill Burr, I love this guy as a comedian. I don't know if anyone's listened to Bill Burr, but he had this whole thing where he's making fun of Steve Jobs, where he's like, a dude didn't do anything. He didn't actually program a single thing. I'm like, yeah, but he had vision, right? But he's right. He tapped into relationship capital, and he did not have the mental capital to build anything himself, but he did have the mental capital to create a vision compelling enough to get other people to build it. So the next part of this is what I call the framework. So the framework is where real delegation exists. And I love when you include your customers in your framework. They're giving you the feedback. They're paying for things up front, right? This framework means you can delegate this. It means that there's other people. When I was speaking in Boston, one of my buddies from Dallas was there who mentored me a long time ago, and he used to go to lunch with a billionaire once a month, Phil Romano. And Phil had this great idea, and then Rick's asking him about, well, what do you need? He goes, I'm just looking for someone that could run this. Looking for someone that could be the CEO. Do you know someone? He said, no. But when they met again the next month, he said, how's that business going? He goes, what do you mean? He says, how far along are you? He's like, I'm still searching for the right person. He's like, the difference between me and you is you're a multimillionaire, I'm a billionaire. You would just hustle. You would just grit it out. You just do all the work yourself. You destroy bandwidth. You wouldn't spend any time with your family. You think it's all about hustle, but the reality is it's all about the framework, right? And so all we're doing is saying what mental capital and relationship capital you need to move it from a concept to a framework. It's a clearer vision. It's proper delegation. It's an architecture behind the production. It's when you can truly delegate to someone that has skill sets that you don't have, that are A-teamers that can actually own it and run with it so you don't have to micromanage it. That's what a framework is. And then from the framework, it becomes a product, a service, or an experience in the marketplace, right? And so how the cycle works is you begin with the thing that someone will pay for before it's even done. And then once you get the money and once you have that first version of the product, then you go down a second round. The second round is what else could we add to it? How can we add more value? What is it that people are looking for? And what some people try to do is go build the perfect thing up front, and then they run out of cash. They run out of momentum. They get frustrated. The market goes, that's not what we're really looking for. It becomes so cumbersome and expensive. Like I have a friend that's building a software, and I'm like, why don't you win then play it? Why don't you pre-sell the software? He's like, there will be bugs. I'm like, tell them there's going to be bugs. You're going to pay a lot less for it right now. You're going to be our eyes and ears to tell us what we actually want to create, because has anyone ever created software in here and had it get completely out of hand? I built something back in 2007. I just had to abandon it. I'm like, I don't even know how to use it. There's way too much functionality. I need something simple, right? We use that and then maybe expand. So that's a cycle of creation. It's how do you win first, then play. I did it with videos. I did it with books. I'm going to continue to do it with books. And I'm going to use the customers to be the funding mechanism so I owe no cash at the end. And not only do I don't owe any cash, I've got momentum. Like when I did 5-Day Weekend, we had a readers group. That readers group started telling people about the book, right? They got included and thanked inside of the book. But when I don't use Win Then Play, it usually costs me. I had this is on camera, so I won't name the organization. I had a big organization that all of you would know want me to create a course for them. So I go and I film the entire course. Now, I go film the entire course, and it's their editors, and they're going to put it up on their website. And in the middle of this, they get sued from a company. They got a licensing agreement that goes sideways. They got all that. So the course just been sitting there for 2 years. So I finally get a hold of them. I'm like, how far along is it? Why don't you just send it to me? And they'd only edited 2 videos. I'm like, we could have done that in the first day. So the lesson there would have been, why don't we pre-sell the course? Why don't we pre-sell the course? And if it's, now all of a sudden there's hundreds of thousands of dollars, I don't even care if they don't have the editors. We can pay outside editors to do it. We've already have proof of concept. So I really like to begin this way, and I've had it work where I had a guy that was like, hey, he was mentoring Harv Eker, and he's like, why don't you come and speak, because I'm not a speaker and you are, and we'll sell this program that we can create together. And he wanted to film 27 videos before he went to speak. I said, why don't we film a video and see what that's like? And then why don't we write an outline? And why don't we pre-sell it from stage? Now, this guy, we probably practiced 20 times before we went up on stage because we were going to share stage. He had it down to the precise moment. What he didn't realize is sometimes when you speak to a group of 900 people, there's a massive amount of energy, and people start taking pictures of your slides, or they clap at the things you say, and so he got all jazzed up and went like 20 minutes over his time. So I didn't even make an offer, right? And I was so glad that we didn't build the product because I got to see that this wasn't really his realm. I didn't want to go into business with them. I referred him to someone else. They did great in a business together, and I freed up my time because I wanted to make sure it was a win for me. And a win is quality of life and money. So cycle of creation, this is scale. This is kind of the third part. So it's mindset first, money second, and then this is really where I feel so much wealth is built in the world, but not enough time is emphasized in it. Like if you're going to do real estate, a lot of like you're doing real estate, like treat it like a business. Like I just find it fascinating when someone who's never invested in real estate starts to talk to me about what a great investment it is and how they're going to get involved in it. And after about 4 questions, I'm frightened for them. I'm like, they have zero exit strategy. They have no clue. They're going to look at 2 deals and take the second one. But like, you just get scared because it's not part of their investor DNA. And so, all right, last piece I won't spend as much time on today because it's what I spent in December, and I know we filmed it. It's the legacy piece. But I will just unveil, because this is what's crazy. So this is called the family legacy ring. And I've been meeting with people that, like I met with this guy that his family is uber wealthy. Like his dad owned a business or did consulting and had all sorts of revenue coming in when he worked with Sam Walton. I mean, very wealthy family. And when I unveiled this family legacy ring to him, he was shocked. Like they hadn't even thought of over half of this stuff. When I spoke at Gathering of the Titans to all these people that had major businesses like 1-800-GOT-JUNK and Burt's Bees and all that, like they had never thought of some of these concepts. And to me, it's crazy that they haven't, but I also recognize for most people, the emphasis on legacy is how do I pass on my money tax-free to the next generation is either A, or B, they have this billionaire, Bill Cummings speak, and his whole philosophy was just to give it all away. And so I was going to ask him a lot of questions about that, but he didn't feel well, and he was in his late 80s, so I just felt like I didn't want to overwhelm him with all my thoughts on legacy. Because I just want to know, did he feel guilty? Is that why he gave it all away? Did he not spend time with his kids to make sure that they were prepared to receive this? Because my thought is, like only those that don't need to inherit wealth will be prepared to actually inherit wealth. People that could actually create it on their own. And so my entire philosophy with my kids is like, they get zero inheritance. There is no inheritance for them. But there happens to be a family bank that they could borrow from. There happens to be this, opportunity for them to start businesses, and we can earn interest in our family bank rather than pay it to other institutions. And there are incentives that if they do certain things, I'll match them so that they have some skin in the game and we have some money that we put into it. And I also make sure that they own life insurance so that when they do die, it replenishes the trust. Because one of the major differentiating factors that I've seen in my early studies is this, that a lot of people, when they inherit wealth and it's managed by some financial team they've never talked to, and that financial team then thinks they're going to grow that wealth by investing in assets that weren't really what made the family wealth in the first place, it gets demolished, it gets diminished. Like they all of a sudden start investing in hedge funds, and some hedge funds are about mitigating risk, others are about trying to grow the wealth. But I view growing the wealth as investing in my heirs, investing in my kids, in their skill sets, in their abilities. That's what we're going to grow. I just want my assets to stabilize. We're going to have downside protection, make it as secure as possible. If our estate grows, it's from one of 2 factors. The kids do really well, and they grow the estate because we earn interest as they pay that back, Or if they make mistakes, which they'll inevitably do, and then we can capture and teach that to other people in in generations to come, so that we don't learn all the mistakes the hard way. We'll still have to learn some the hard way, but hopefully we can diminish some of that. Then the reality is the life insurance will replenish it. The life insurance will replenish whatever they did diminish that estate, so there will still be money for future generations. But if we are going to grow this, it's going to be through looking at people as assets, not products. Now, if some of them end up starting a real estate business and they're phenomenal at it, then great, that'll be part of the portfolio. But we're not just going to go throw the money in a REIT that we know nothing about because someone told us that's what we should do, and now we're just, now we're just following the masses. That in finance, I think the world wants, in the poor and middle class, they want money to be automatic and simple. They want to hand it over with no responsibility and have someone give it back to them. And this is why there's absolutely no hope for them in that situation. There isn't. Like, I don't mean to, rain on anyone's parade here, but 95% of people at age 65 are not economically independent, according to the US Department of Labor. 95% of Americans, they get there, if they stop working, they're going to lower their income and not be able to make ends meet. Is that because of a lack of effort? Well, it isn't a lack of saving money. It's a lack of knowing how money works. So they think, oh, I'm not going to protect myself, I'm not going to worry about asset protection, and I'm just going to spend all that money on a mutual fund, and the mutual fund's going to underperform horribly because of flash trading and fees and the restriction of where they can actually invest, because it's all based upon the growth objective, even though it might not be a growth time. And then they thought they were going to earn 10%, and when they get there, they find out they earn like 4%. And even if they accumulate $1 million, which they weren't millionaires to begin with, but even if they get $1 million, how much interest are retirees getting off living off interest of $1 million today? Like 4%? 40 grand, who feels like a millionaire at 40 grand, right? My kids are figuring out like ways to make more money than that at moments, because they're, pretty sly about a few things. And then other times they're under minimum wage, because we have this whole deal with our kids. Like if they want to earn money, they come and present strategies to us, like how they're going to earn it. And then if I agree that, yeah, that's something that I'd like to have done, then they tell me how much they want to be paid for it. And I either say yes or no. And if I say yes quickly, it means they've underbid themselves. And then they immediately go, And I'm like, no, we have an agreement. Learn some lessons, and it's no if they're asking for too much. But that doesn't feel like being a millionaire, getting $40,000 taxable, by the way, more than likely. So the game is rigged against them. And without a little bit of responsibility and without understanding money, like money is lifestyle. So if we don't figure it out, it will infringe upon our lifestyle every step of the way. Cash crunches, lack of protection, because all of us are in store for financial surprises. We're all in store for that. It's just that 90% of the time we can actually be okay if we prepare for that, but most people don't, because they don't understand the value of protection and transferring of risk, and like it's just funny. Some people think, oh, it'll all be better once I have more money, but Biggie Smalls said more money, more problems, right? And the reality is, the more money you have, you're going to experience success tax over that. Someone sees you successful, they want what you have, whether you deserve it or not. 20 million lawsuits per year filed in the United States. We don't have tort reform, so you have to pay your expenses on that side, even if you're right and they were wrong. So this is just the litigious society we're in, that once again comes from a mindset of wealth is a game of luck. It's a zero-sum game, so if someone has something, I have less. It comes from scarcity. Scarcity is insanity, and that's why we have all this kind of problematic situations. But the family legacy ring, talking about legacy, begins with the family office. So the Rockefellers are on 6 generations of passing on wealth, $50 million last year to charity from their interest, 153 families benefiting from that trust, although we're not looking at trustafarians and trust fund babies. We're looking at bank presidents and senators and some actual power that's happening there. Part of what they had, the Vanderbilts didn't, is they had a family office. So they had a family that just for the family, they had a financial firm that only worked for the Rockefellers. Now, I don't know if anyone in this room's in that situation where you have just one group that only works for you, but now a family office might take on 10 clients a year or 30 clients a year. But now you have a cohesive, comprehensive, coordinated team working on your behalf that understand who you are and your philosophies, and that they're actually making sure that everything's working in unison. So a family office is a big part of it. The second part is a family retreat. Now the family retreat, I think, is the most underutilized, unknown part of legacy and might be the number one factor of anything I'm about to share. Now, family retreat doesn't even do it justice. Family retreat comes down to everything from symbols for your family, rituals, and traditions as one of the core pieces. It comes down to how you invest in your heirs from a time standpoint, from a meeting standpoint, from articulating your values and your mission. Like, think about everything that we admire about an extraordinary organization. Can you think of an organization out there that you really admire that has no values, that they haven't listed their core values? Or they don't have a mission or vision statement? Or they don't have regular meetings with their executives? Or that, it's like all those things that make a business extraordinary. What if you looked at the business of your family and said, how are we ever going to expect our heirs to be prepared if we don't invest time and we don't have some type of meaning behind everything? Like, look, it was tough last year. Last March, I sat down with my kids and my wife. My kids were 10 and 12 at the time, or 10 or 11 and 13 or whatever, and we sat down and we had to figure out our values. What did we do? We had a huge list and we let everyone circle 7 things. If we agreed to any of them unanimously, it was immediately a family value. If we didn't, we put it out there and we each got to make a case and talk about it until we agreed to at least 5 that we could count on. Then we wrote a family mission statement. Yes, I wrote the majority of it. So in writing the majority of it, now what I'm doing is meeting with my kids up to twice a month. We don't do it too often, but we read the mission statement together and we ask about, what does that mean to you? And that's been a difficult situation because the 11-year-old regurgitates what I say half the time rather than saying what it means to him, right? But I want it to live in their hearts, not just on our walls. We created a family crest. Everyone got to say what we wanted on that crest. What were the symbols? What were important to us? And after we did that, I hired an artist that just lives down in the valley, if you look down there, and we made it an actual shield that sits above our mantle. So like medieval times, like kick your ass medieval times. We got a family heirloom that we can now pass on for generations. But what's cool is we wrote what all the symbolism was, and now when people show up to our family cabin, my kids can tell you what the different symbols are and why the colors of it and what the meaning is. So they're starting to have this integrated into their life. That's what family retreat is. That's actually taking the time to invest in your heirs. Like, I'm having t-shirts made for Christmas this year that'll have our family crest on it. It'll have our family values on the back of it. It's just something that we could wear, maybe when we're around the cabin or it sparks up a conversation, or it's just that nice nudge and reminder of who we are. All right, the next piece is the family constitution. The U.S. developed the Constitution. It was 4,400 words. Changed the world for that matter, because now almost every nation has a constitution. And it was an outline and a guideline. It was a signpost to say, how do we preserve and protect life, liberty, and the pursuit of happiness? How do we avoid anarchy and starting over again and again? And what are these kind of distilled philosophies that can help us to be more prosperous? Once that was articulated, it wasn't meant to be like a commandment that we follow exactly. You'd know that for sure watching politics these days. But it was meant to be like a guideline of how things were to operate. And by having that, there could be signposts for future generations. And what if you had your own family constitution, which was the preamble to your trust? So before it gets into the legalese, which is essential for the courts or to avoid courts or for interpretation from attorneys, but none of your heirs are going to be excited about reading that. But they could be excited about reading what are the most critical lessons and philosophies. What helped you to initiate and get started with what you've created? And how can you pass down some of those, ideas for them to improve their lives? So I look at the family constitution, and I did 2 additional things to it. One is I created an appendix to it, and that appendix was the workbooks to help them have self-discovery. So it wasn't anything I was mandating, but I'm just really promoting building a life you love, living your sole purpose, understanding the difference between scarcity and abundance, because my family didn't understand that. My great-grandfather knew scarcity at a personal level because he could not literally put food on the table. I know some people say that these days, but it's not hard to put food on the table these days, right? It's not like you have to go out and hunt and, and cook it yourself. It's like you get food stamps if you don't do anything, and that buys food. or you ask family and friends. It's not that hard to do, but in 1913 in Italy, in San Giovanni, it was so hard to do that my great-grandfather left there to get on a boat and come to the United States, become a goat herder, and eventually a coal miner, because that had more opportunity than what he was doing there. Because the mob was taking his profits, and the government was, to a point that he couldn't make ends meet. Like, he started to experience separation from family. That separation had him to start to feel scarcity. So everything was about how do we protect our family, but it became the play not to lose mantra. It became protecting us from our greatness. It became protecting us from stepping outside of that comfort zone and doing something meaningful. And so I wanted to have a family constitution that said, look, bold moves and courage are great, and we're glad for what was started there. But the reality is, we want you to really figure out and discover who you are when you're at your best. And if I'm not here to tell you what career to choose, but to choose one that aligns with who you are. Maybe it makes a lot of money, maybe it doesn't. The good news is, we're not starting you into financial bondage where you're begging for the banks or having to go and get a student loan, which is absolutely a crime in today's world. Student loans are wrecking this world. It's inflating the cost of college and overpromising to our youngsters what's actually possible. I don't give a shit if someone has a degree when I hire. I don't care. Can they do the job? I mean, how much, like, when I think back to what I learned in college, it was stupid. A lot of it was stupid. I took a nutrition class, and they taught the food pyramid. The food pyramid. The brain needs fat. They're saying limit all fat. 6 to 11 servings of carbs. You know, the carbs have always been the best thing for everyone, from what I understand, especially the more processed they are. I mean, like, this is the stuff I learned. And by the way, in today's world, it's moving too quickly for them to keep up. So I'm not completely against college, but I am against borrowing and thinking that a degree means everything. It doesn't. Who you are means everything, and that's what I want my heirs to know. And that not all education comes in a classroom, right? It comes in the masterminds that I've joined. It comes in the people I associate with. Like, one thing I know, because I'm an author, like I just bought my own website. There's another Garrett Gunderson out there. I couldn't get a hold of him for like 15 years. But he's had the same stupid resume up there for 15 years. So like sometimes people are like, I expected more out of your website. I'm like, yeah, me too. Like, I get it. So I reached out to him, you know. I reached out to him to try to buy the website, and he's asking for a really high amount of money. And then finally he kind of meets me where I was saying I was willing to go, but then he mentions, as long as I get a signed copy of your book. I'm like, oh, this is unfair. Like, as soon as you appeal to an author's vanity, you own them. I understood that, so I don't read as many books as people think. I just talk to a lot of people that write the books, because it's actually a lot easier to access them than most people know. I mean, hell, if you actually have read my book and you say a few good things that I actually can tell you read it, I'm apt to get on a phone call. I'm apt to email back. It's a lot easier. So I do a lot more just looking where's those sources and being able to ask questions, right? I think the number one skill set I want to give my kids is knowing how to ask questions, because questions lead to wealth. Good questions lead to wealth. When I listened to Evan Carmichael speak to this group, and every question was about an idea for 15 years that they hadn't taken action on, and every time he said, what's the 2% you can do today? That was his whole speech for 4 hours. But because I brought 25 people with me, he said, hey, you can have an hour of my time. So I had an hour of his time the next day. I asked different questions. It blew my mind. I was like, are we recording this? I called people into the room because he had a wealth of knowledge that people didn't know how to tap into because they weren't asking the right thing. Like, people aren't asking the right thing when they wake up and they go, how do I make more money? I'm not inspired to talk to someone that's all they ask. Where should I invest my money? Well, you're asking the wrong questions. How do I become a better investor is a much better question. What value can I truly create in the world? Like, I don't even like when people hear me speak and then they come up and say, what value can I, or how can I help you? Like, that's okay. I get where they're coming from, but now they put the onus on me. If you, like, what I want to teach my kids is, what if you ask them what they're excited about, what they're up to, what their biggest obstacles are, what their biggest opportunities are, what connections they would like. Like, get the work done on your part, and then when you can connect them to someone or give them an idea, you now can be the value provider rather than, because look, even the best people out there, if you could truly help them, most of the time have a conditioned response to say that they don't need any help or that they're good. But everybody here could have another level of prosperity with new mental capital or new relationship capital. It's just most people don't know how to ask for it, and most people don't know how to offer it. So the family constitution is really this distilled place where I can have a dynamic legacy. A dynamic legacy where it's not just legalese, it's not just passing money on, it's passing on the more important things. And in between this, I have a board of trustees. Not like a bank board, not like your board talking to them because they're so stuffy. I have a board of trustees that are 5 people that if I'm not around, share key characteristics about me that I either have the same or better, the people I even look up to, that if I'm not around, that's who my kids can learn from. That's who my kids can consistently meet with so that they still get that information and they still get instilled into them some of those key values. And by the way, I left them with a family constitution, a family mission statement, I've left them with family values, I left them with Gunderson Boy rules, I've left them with workbooks in the appendix. Like, I've given them the resources. And as a matter of fact, I'm inviting all of my board of trustees to my cabin this fall to come hang out so they could spend time with my kids, we can have conversation, and I can once again paint this vision. Actually, last week, I filmed a video that now goes to the preamble of the family constitution. It's 20 minutes where I'm just talking about, hey, I'm just putting myself in my future heir's shoes and think, okay, imagine if you had a family member that set up a trust with tens of millions of dollars in it, a family constitution, and they had certain bios, because everyone has their bio that people read about them. But what if I had my wife get up here and do a bio? Totally different, right? She could tell you all the dirt, right? My kids would love to sell me out on that, and they think it's funny, right? And I feel like I don't want my heirs to feel like, oh, grandfather or great-grandfather Garrett, he did everything right. No, I've made a lot of mistakes along the way. I've lost money, I made bad investments, had bad partnerships. So I actually just talked about that and the importance of mistakes and the importance of discovering who you are and loving yourself, not comparing yourself to anyone else, and that the expectation isn't to be who we were, but to find the life you love. So I wanted to have that in my words and that are presented in there, so I put just together a video that goes at the beginning of the family constitution. The board of trustees, I want to spend time with them so that if I'm not around, I have a good influence on my kids, and they're looking at the family constitution to interpret what we want to have happen. So, in between here, I have a trust protector, the family office and the family constitution. The trust protector is actually an attorney, and their main job is to veto things. Their main job is to go, hey, it looks like you're putting the assets at risk. I'm going to say no. They just have this fiduciary responsibility that we don't put our capital at risk because we're going to invest and take risks with our heirs, not with our cash, right? So I've got that in between there. Between the family office and the family retreat, I've got what I call the 3 R's: review, rate, and refine. Review, rate, and refine. That's doing our regular meetings. That's introducing them to the financial team. That's having conversations even when they're 11 and 14 and they might not understand everything, but they're getting exposed to that early on. And here in the middle is the Rockefeller method. In the middle is the life insurance that is purchased on every heir so that when they die, it replenishes the trust. A quick story on this, because I'm in the middle of research on this, so I don't know every detail. And so I will admit I have a bias here, okay? So just a little bias here. But if we look at the companies with pensions that absolutely don't have that pension anymore and they declared bankruptcy, one of the most common things when I read The Fate of the States, when I read that book, what I found was so common is all of those pensions relied on the stock market and expected the stock market to do 8.4% in order for those pensions to work. Those pensions did not work. Well, let's rewind. Before they relied on the stock market for pensions, GE did something extraordinarily win and play. So GE did something called non-qualified deferred compensation, which was a pretty pioneering thing in pensions. So non-qualified just means it's not like a retirement plan, like a 401k or a simple or a SEP. It's not government qualified, it's a private contract. Deferred comp is exactly what it sounds like. It means you work here for a period of time, we'll pay you a pension in the future. And the reason that they came up with this idea was they were not number 1 or number 2 in every category in the 1950s. They started to slip with some of their businesses. And they said, if we're going to keep these businesses, just hit puberty, did you hear that? My son's voice is as deep as mine now at 14, it's scary. The questions he's asking me, My wife says I shouldn't share them in public. It's just funny, the stuff that's coming out of this kid's mouth now. But one of the things that happened is they were like, we have to recruit great people. We have to go recruit the best. How are we going to get the best? So they'd have to go because all the best were already employed. They weren't sitting around twiddling their thumbs, going, so glad you called. You had to recruit them away. So what they did is they said, if you'll work for us for at least 7 years, maybe 10 or 12, and we get to number 1 or number 2, we're going to give you a pension for the rest of your life. But to fund that pension, they didn't go rely on the stock market. Instead, what they did is they bought life insurance on these executives. Cash value-based life insurance, and that cash value would grow over time, right? It would grow over time, and then it would either fund or supplement the retirement. And when I say fund, because a lot of these guys died early back then, right? Remember when Social Security started at 62 and the average age of death was like 61? Brilliant program. Now it's like 90, we're kind of having a problem there. But they would use it to either supplement or fund. So they'd use the cash value. But they weren't really interested in the cash value. What they knew is these executives would die before GE did. So what happened is when the executive would die, they'd get this tax-free death benefit that would come back to the company and replenish them at a 6 to 7% rate. So they weren't reliant upon a volatile market that they couldn't control. They had more predictability. They knew this person was going to die. When they died, that money would come back in. They just didn't know how long it was going to take for them to die, so the return would be less the longer they lived. Because back in those days, you get cash value, but it wouldn't push your death benefit up like it does today. Now, when you put in more cash value, there's more death benefit. It grows over time. But back in those days, it just kind of grew, and the cash value and the death benefit was level. So they used this kind of philosophy. Well, I'm thinking, what if you use this in your family? Look at your family as an ongoing concern. It's not when you die, the family's gone. What if that life insurance is there to replenish whatever you spend, whatever you utilize? Once again, not having to take risk with the stock market you don't control. Not everybody could be as good with their timing as George Steinbrenner, where he dies the year there's no estate tax. It's the Yankee. I'm still suspect that someone use a pillow. I'm just saying. This would be really convenient for our championship hopes if you could die this year. Yeah. So, this is the family legacy ring. And I'll just let you in on this. This is useful, it's good to know. But the most important thing in your legacy is how you choose to live your life today. Living from abundance, right? Having quality of life be an integral piece of what you do. Not hoping, I just need to challenge a concept for a minute. How low of a concept it is, and yet it's a low concept with massive failure. The concept of retirement, if you really want to retire, let me tell you this, I'm going to be able to recruit your employees. No employee wants to come work for you because you're going to retire. As soon as that becomes part of your vernacular and your goal, the vision isn't what you're up to in your company. They're funding something for you, not for the betterment of society or bigger impact. It's a very small vision. And look, my dad's a coal miner. Retirement was a good idea for a coal miner. But if you have a vision that's compelling to you, imagine if in the world, for just a minute, instead of people focusing so much on their bank accounts, I think stewardship's important. But what if our focus started with our purpose, and we spent as much money and time and effort in growing our purpose as we did our bank accounts? You know what happened? Our bank accounts would grow. The people with the biggest purpose, they had more money than they could ever spend in a lifetime, but they didn't retire. If we redefine retirement, there's 2 ways to redefine it. The first way is to retire into something that you enjoy. And the goal is to retire from the things you hate and find weirdos that like doing those things. Right? There's people out there that love doing stuff you hate to do. I know we're going to be talking asset protection. My attorney once took me to an 8-hour asset protection seminar. 7 people sitting at microphones, very monotone. And he was fascinated. He's nudging me. Can you believe this? I'm like, I'm thinking about suicide. I don't even know what they're talking about. But I love that he's so fascinated by it, right? That's what I want. There's people who look at all the stuff I'm doing, who wants to study this? I love it, right? But there's other things so we kind of have this amazing diversity of people and what we all enjoy and love. But if we redefine retirement to retire from the things we hate and retire into something that we can continue for the rest of our lives. I find that when people lose purpose, that's the closest they're going to get to death. Like as soon as purpose is gone, happiness follows, and ultimately, like my grandma was in amazing health, but her main purpose was my grandpa, because she got him dressed every morning, put out his clothes, put out his pills, made him food, planned the schedule. They went to church every day. They did all this kind of stuff, and then she told him how to drive. And if she didn't, he would miss the exit, and he's like, how am I supposed to know that's the exit? You didn't tell me. Like, as soon as my grandpa died, my grandma died a year later. The purpose was gone. And so we're writing an article in Forbes right now, and we came across this study, and it was saying that when people retire at age 55, they're 9 times more likely to die in the next decade than someone employed. So I kind of feel like retirement becomes a bad habit. Like, we're willing to tolerate too much crap along the way because retirement's the shiny thing at the end. Like when I went to Italy for 2 months, like you talked about, I'm like, we're just going to do the things now along the way. We're just going to do them now, and then I'm going to come back to something I enjoy. Because it's fun to be in Italy for 2 months, but at the end of the 2 months, I'm like, can we just do like a grocery store shopping? I can't do a 4-hour dinner. I'm like, I'm done with the 4-hour dinner for today. There's just and it was exciting to come back, but I'll tell you what, for anyone that doesn't love what they do, the best test you can do is just take a 2-week vacation, completely unplug from work, and if you dread coming back, you're doing the wrong things. It's either time to do something new or delegate a lot better. And my secret to delegation is very simple yet profound. I don't delegate any tasks. I'm not a task delegator. I used to be. In my 20s, I'd just delegate a task. When I was finished giving the task, my assistant would come back and say, okay, what's next? And then I'd give her stuff, and she'd come back and ask what's next, and we do that over and over again. But instead, I decided I'm just going to hire really amazing people and say, hey, Aaron, you're going to be the president of Wealth Labs. What's our objectives? Okay, those are the objectives. Run with it. Come to me if I can support, but you own it like it's yours. Like, I'm going to count on you 100%. When you can't delegate like that, you have the wrong people. This is the longest outline I've ever done. That's just the outline of what we're covering. Any questions so far? We'll take a pause for questions before I go into some of the money efficiency. Yeah.
My question is, once families get large, you have to prepare for, I call it a 10% rule. 10% are going to be disabled. Whether it's a stroke, a health event,
Yep.
a spouse, a child, and their purpose is much different. And,
Totally.
I'd like your thoughts on that. How does that fit into your circles? It's not so much the retreat aspect of it, but maybe within the Constitution and
Yep.
The wealth strategy of that as
So
well.
one of the things I added to the Constitution is, one, we get insurance as soon as 30 days in. Our kids are born, 30 days later you can get insurance. We get it the second we can because we have family history of polycystic kidney disease. We have uninsurable people that are older than us. So we're getting it as quickly as we can. And I read a book called Deep Nutrition, and it had this term called genetic wealth. Genetic wealth. And if you believe in epigenetics and that we have influence over, through our stress levels and the food that we eat and the time that we spend in nature, and we made a choice 10 years ago where one investment that we will always make in our heirs is for their health and well-being, right? So if they're being proactive about it, bam, the trust is there to support that. If they're having to be reactive because it's difficult, we don't want them relying on doctors in their insurance coverage because insurance is not meant for health. It's usually crisis care at best, and so we actively invest in those people, right? So if we have someone that, let's say they were disabled and they're not able to be employed, we're just looking what's going to give them an enjoyable life? We're happy to finance that. If they don't pay it back, even if they couldn't get insurance, this is why every other heir has insurance. This is why every other heir has an opportunity to go out there and produce wealth. Like, we're just going to take care of them. Like, absolutely going to take care of them. And guess what? That might not even be my immediate family. If my sister had some special needs child, like right now, my sister-in-law is divorced, and her husband is doing everything he can to make her life miserable. That's his new purpose. And ultimately, she's, doing everything she can to create a stable environment for her son. And the reality is, he's like, nope, if he's going to Catholic school, I'm not supporting it, and all this. And I'm like, cool. I told my wife, I'm like, whatever she needs, we'll just go ahead and fund that, right? Because I realized at a time in 2008 where I was in a cash crunch, that I was in a survival mindset. I was just like, what is it going to take for me to get through this? I had very little to give to everyone else because I wasn't in a place of excess or abundance. And for me, for someone to even consider legacy important, they have to be in abundance and excess. If they're in survival, that's not even a conversation you can have because they're just trying to make ends meet. So I recognized what it meant in my family because in 2008, my grandfather lent me money. My mom was, I didn't know, putting money into the business just to get us through that cash crunch. And I'm like, wow, like think about what that meant for me to be where I'm at now and have the lifestyle and the impact because they supported. I want to be that support, which means I have a fiduciary responsibility to my family to be productive throughout my lifetime. Now, to be productive throughout my lifetime, I'm really clear that means taking time away, having rules where I'm done with work at a certain time, making sure I'm not traveling too much, like creating parameters to protect myself. But I just believe, hey, whether it's immediate family or extended family, we're going to be in a place where we can support that. And I want them to have the world's best. Because I got, just a quick story on this. My 14-year-old, he had a good 7-8 years of his life where we had no clue if he would ever be able to live on his own in the future. He got kicked out of Montessori school because he had an auditory processing issue. He had 0 friends. We put him in a group with Asperger and autism kids. He's neither, but he was actually interacting worse than them. And so my wife and I said, we're just going to do whatever that takes to help him out. Let's fast forward. He's 14-year-old now. He's a 14-year-old. Last night he's showing me some friends that are Snapchatting him, right? He's on Friday, I'm like, why don't you go up the county? He's like, well, we're going to go hang out with my friends. He has friends now. That's a new thing. 2 years ago, he didn't even get grades. We found out part of it is he has 164 IQ. You're going to have a lot of lopsidedness in that, right? But by investing in him, we're watching him become his own person and have these gifts and abilities and confidence start to come up. And so it's like, it was worth every moment, flight, dollar. And look, we wasted money trying to figure it out because we just didn't know. But I look at everything I discover, everything that I'm going through to even have more self-awareness and invest in myself. Not even just from business knowledge and marketing knowledge and speaking, but really just an awareness of any place where I'm not accepting of who I am, therefore I'm disconnected or not fully embracing, loving myself because I've got to be in that place to be an example to my family. I'm just thinking about it when I was driving today. I'm like, I now have resources for my family because I've pioneered some of that. And then if they're ever facing that, I'm happy to bring that resource in. So that's why I don't look at my network as just people I do business with. I look at my network as all the relationship capital that support my family for generations to come because we have brilliant people in health, we have brilliant people in wealth within our accredited network and family office and all those things. So you just do the very best you can and you support where you can. I wouldn't put yourself in harm's way to support that with extended family, but if you can put yourself in such a powerful position, that's why economic independence is critical. Because being economically independent, I have that freedom to use that money to support, to do those things. Plus, when we went to Italy last year, we actually went to Croatia first. I brought my nephew, I got the villa, I covered a lot of the meals. They just had to get there. And it was, he got a Student of the Month last month. He talked about how his uncle took him to Croatia. I don't know where Croatia is, went to Croatia. But it's he's remembering that. And I'm just sitting there thinking this kid's trouble. I love him for it. But when he's in trouble, I might be the one bailing him out of jail because I'm super close to him, right? So I'm investing in those experiences and in that time together. Does that answer your?
Yep.
Yeah. Other questions?
Garrett,
Why don't we take a break?
Yeah.
maybe?
Yeah, well I've got one question
Okay.
for you. So, your generation, assume your parents didn't start any of this. So you and your wife were starting this with your boys at
Yep.
a relatively early age. It's a great place to start. We've got people here with different generations. We've got people with kids that are grown. If someone here wants to start that, or we've got our two apprentices. Hey, Olivia, Sarah, our two apprentices back here in the back of the room. They're here soaking this up. They want to start the conversation in their families. Where do you start? I mean, where do you start to bring people together and see who's on board and who's not, and who do you decide is not going to play ball, and you just got to start somewhere? Where's the corpus begin?
Well, I'm trying to see how to say this without being totally self-serving. But for me, I've known about this for a long time. I got it done in 2.5 days at our legacy retreat. And we had people that their grandparents brought grandkids. They brought their kids. Not all of them wanted to show up, but you just start progress over perfection. Done is better than perfect. Like, you don't want to force it on someone, but I was talking to one of my buddies, Tom Preston, and having these conversations, and so in December, he had everybody out to his cabin, and got one daughter that's married, another one that's engaged, and he said that the two men that are now coming into the family were just fascinated and excited about it. But he said his younger daughter didn't really care. It just seemed like an annoyance. Like business doesn't go perfect, right? Business is just a series of imperfections in a lot of ways. So to me, it's just moving forward. So I started by calling up Rich Christensen. He wrote the book Toes Turn Purple, which is phenomenal in this legacy conversation. My wife and I met with him over and over again. Our kids were really young early on, so it wasn't time to really start this. But then, he hosts the family retreat event that we host at Wealth Factory now. So I bring him in. He went into the Gathering of the Titans and did a whole thing on family retreat for them, and what they said when he was finished is this deserved a whole day. Because what I found was the whole conference is around legacy, and there's a lot of good ideas and no practicality. There was a lot of people who've done it but didn't know exactly how they did it, telling about an after-the-fact story, not retracing all the steps properly, and Rich had the very specific framework, right? From the conversation you have when they're 8, whether it's a grandkid or a kid. When they're 12, the type of experience you have when they're 14, when they're 16, and you know what, he's just raised 5 amazing kids, and he now has a bunch of grandkids, and he feels 100% confident and certain. When I first talked to him about this, it was like really tender for him because he'd only been doing it in his family. I'm like, dude, you can't hold this to yourself. I'm sorry. Like, you got to put it out there. I'm like, it's going to be critical. And so now he's showing videos of his kids with their first businesses. I mean, he had a kid that did $590,000 in revenue at 16 with the business because he was his business coach. And he's like, I want to teach him entrepreneurship, right? He's like, I might not be a coach for their sports teams, but I might be a coach for their business. And he says, everyone has at least one business when they're 16 so that they can learn about it because they have to pay for their own vacation, their own travel, their own philanthropy, and then they have to donate all of it when it's all said and done because he started having his friends want $100 an hour to work for him while they're 16 years old. So he says, okay, this experiment is done now, right? But now he's got kids that are running amazing businesses. So like, you could hire him, have him facilitate it, you know? That's kind of what I've seen people do, and you can read the book, and you just start with one thing you know you can dial in on. Toes Turn Purple, it's on Amazon. It was a business that he did with his 16-year-old. So his 16-year-old writes part of it, and he writes part of it. The title means a lot to him, not as much to us. I would have called it more about like generational wealth or investing in your heirs or a number of things, but he did it with his son and did it his way. So once you get into it, I think it's really great.
Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.